Welcome to the Deep Dive. Today we're tackling the Q2 fiscal year 2026 results for LTIMindtree. Our mission, as always, is to go beyond just the headlines. We really want to understand the story behind the numbers, especially, how a major player like this is handling the huge shift towards AI in everything they deliver.
Yeah, and the management commentary actually gives us a pretty clear signpost here. The CEO specifically called it a strong quarter. He highlighted broad-based performance and also margin improvement that was ahead of plan.
Ahead of plan that always catches my ear.
Exactly. When a company says that, you really need to dig in. So our job is to take these financials, the press releases, and see if those claims hold up and figure out what trade-offs they might have made.
Okay, let's start unpacking then. The big headline number, maybe. In Indian rupees, they crossed a pretty significant psychological mark this quarter.
Oh, yeah.
Revenue hit over 1 lakh crore rupees. That's 10,000 crores. Just gives you a sense of scale.
Definitely sets the stage.
Right, so diving into the core financials now, the ones usually quoted in USD. Revenue was $11,180.1 million.
Okay.
That represents sequential growth, quarter on quarter, of about plus 2.3%.
Pretty steady.
Steady, yeah. And maybe more strategically, the constant currency growth, which kind of smooths out the FX volatility.
Right, the underlying business growth.
That was plus 2.4% sequentially and plus 4.4% compared to the same quarter last year.
Okay, so decent top-line growth. But you mentioned the bottom line earlier.
Yes, that's where it gets more interesting. Net profit after tax, or PAIT. It didn't just grow, it jumped. Plus 10.1% quarter on quarter.
Wow, okay. That's quite a leap compared to the revenue growth.
Exactly. It landed at over $13.8 billion. And this strength, it flowed right through to the shareholders.
Yeah.
Basic earnings per share, the EPS, hit an all-time high for them at 47.28.
An all-time high EPS with only 2.3% sequential revenue growth. That points directly to margin expansion, doesn't it?
Absolutely, you hit it. The real story seems to be how they manage their costs and efficiency this quarter.
So let's look at that operating margin, the EBIT. That's a really significant jump. We're talking 160 basis points sequentially.
160 BPS. Okay,
Yeah.
break that down.
Yeah, 160 basis points, bringing the EBIT margin to 15.9%. And just to put that in perspective for you listening, 160 basis points is like gaining an extra 1.6 cents of profit on every single dollar of revenue.
Right. At their scale, that adds up incredibly fast.
It's a huge amount of operational discipline, or maybe something else.
Okay, so the big question, was that 160 BPs jump just good luck with currencies, or was it pure execution on their part?
That's what's so revealing in the commentary. They actually broke it down very clearly. It was a perfect split, 50-50.
Oh, interesting.
Yeah, 80 basis points, so half of the gain came from what they called Forex tailwind, favorable currency movements, basically external luck.
Okay, so that's the luck part. What about the other half?
The other 80 basis points came straight from internal actions. Their ongoing Fit for Future initiative, that's their internal program for operational improvement. Plus, they didn't have the high visa costs repeating from previous quarters, so pure operational gain.
Right, that non-recurrence helps too.
It does, and what's really fascinating here is the discipline it shows. Improving the EBIT margin, hitting that 80 basis points of pure operational efficiency while they're absorbing the costs of things like training 80,000 people on Gen AI, that's impressive.
Yeah, that's a major investment.
Huge. It shows they're basically funding their future AI transition with the efficiencies they're driving today. It's a really strong strategic signal.
Controlling what they can control. Makes sense. And for the investors holding the stock, this performance was backed up too, right?
It was. The board approved an interim dividend, 22 per equity share.
Okay, so solid financials, strong margin story. Let's move to that second claim management made. Broad-based growth. They said every vertical grew sequentially. Is that how it played out?
Well, yes and no. Technically, all verticals showed some sequential growth, but broad-based might be stretching it a bit. The growth was definitely uneven.
Okay, so who are the leaders then? Where was the real momentum?
The momentum really came from two key sectors, actually outside their traditional core strengths.
Right.
First, the consumer business vertical. It showed really strong quarter-on-quarter growth in USD terms, up plus 9.1%.
9%, okay. That's significant.
And even stronger was healthcare, life sciences, and public services. That vertical grew by an impressive plus 10.2% sequentially.
Wow, double digits.
Yeah.
So any insight into why those specific sectors surged? What's driving that demand?
We can infer a bit. For healthcare and life sciences, you're likely seeing continued spending on things like regulatory tech, post-pandemic modernizations, and getting Data platforms ready for, well, AI, basically.
Makes sense. Data readiness is huge there.
Huge. And for the consumer vertical, a surge like that, it often points to clients investing heavily in things like new digital commerce platforms, customer experience tech, maybe personalized marketing, things that touch their end customers.
So investments in growth from their clients.
Right.
Got it. Now let's pivot to the giants in their portfolio. Banking, financial services and insurance, BFSI and technology, media and communications. Together, they're what, about 60% of revenue?
Roughly, yeah. They're the core.
So how did these massive segments do?
And here's where you see the tension. BFSI and tech, media and comms showed very minimal sequential growth. BFSI was up just plus 0.2%.
0.2%. Okay.
And tech, media, and comms was even flatter at plus 0.1%.
Wow. Okay, that definitely needs context against the strong overall margin story. What did management say about that?
They were quite open about it, actually. They noted that BFSI specifically had a really strong run in the previous fiscal year, FY25.
Right.
And now it's going through what they termed a recalibration phase. And that word recalibration is key.
What does that mean in practice?
It means, essentially, as existing contracts come up for renewal, the clients are asking for, and LTIMindtree seems to be proactively offering productivity benefits driven by AI.
Ah, so they're passing savings back to the client.
Exactly. Which acts as a drag on the reported revenue for that segment, even if the actual volume of work or the scope is stable or even growing.
That connects a lot of dots. Okay.
Mhm.
And geographically, any shifts? North America is still dominant.
Very much so. North America still brings in about 74.2% of the revenue, but it is worth noting all geographies did grow sequentially. The rest of the world actually led the pack with plus 3.7% growth.
Okay. Now, this is where I think it gets really interesting. Let's connect those flat core verticals back to this whole AI strategy and recalibration idea.
Right.
Let's look at client concentration, specifically their top 5 clients. The percentage of total revenue coming from just those 5 biggest customers. It dropped.
You're up noticeably, yeah.
Yeah, from 28.4% in the same quarter last year, Q2 FY25, down to 25.3% this quarter.
And that drop, that 3 percentage point decline in top 5 concentration, you can almost draw a straight line from that to the AI productivity discussion.
How so?
These huge, long-standing accounts, they are precisely where management is likely deploying AI most aggressively right now to deliver those efficiency gains we talked about. This puts them right in that transition phase.
So the AI benefits are hitting the biggest clients first, leading to lower reported revenue from them, even if the relationship is strong.
Precisely. The productivity gains are being passed back, effectively offsetting some of the revenue from new work or expanded scope within those accounts. Think about it like this. If AI helps them deliver a project 30% faster for a top client, the total bill for that project might shrink, even if LTIMindtree is actually doing more complex work overall for them.
So they're prioritizing the long-term strategic partnership, becoming that AI partner, over just maximizing the revenue from that specific account in the short term.
That seems to be the calculated bet they're making. Absorb a bit of a financial hit now on the top line with these key clients to solidify their position for the future.
Right. And the CEO's commentary backs this up.
Absolutely. He framed it exactly as a transitionary phase, explicitly stating it's not a structural issue. His argument is that they're winning more new business and larger scopes than they're giving away through these productivity savings.
Okay.
The commitment, he said, is to become an AI-centric organization. And they mentioned deploying their own internal tech, Blueverse, across the delivery stack to help achieve this.
That kind of shift, becoming AI-centric, requires a massive change in the workforce, though, doesn't it, if tasks are getting automated?
Absolutely. Your people need to move up the value chain, do different things.
So what are they doing internally to prepare their talent for this? Any specifics?
They gave some pretty impressive numbers on that front. They reported over 80,000 employees have completed their internal GenAI Foundation training program.
80,000. That's nearly their entire workforce.
It's a huge undertaking. Shows you the scale of the upskilling effort required. It's a massive operational commitment.
And organizationally.
They also appointed a new chief delivery officer. The stated goal for that role is specifically to enhance client delivery and, crucially, embed AI directly into how they deliver services. It sounds like a structural change to support the strategy.
Okay, and this ties back to something you mentioned earlier, the operational side, their new compensation strategy. Spreading wage hikes over 2 quarters, January and April. How does that fit in?
Yeah, it connects quite neatly, actually. Spreading the hikes helps manage costs quarter to quarter. That frees up resources, helps fund those huge training programs we just discussed, and makes it easier to absorb that short-term revenue pressure from the top 5 clients going through recalibration.
So it's about cost management to enable investment.
Exactly. And by framing this staggered approach as potentially a new normal for the industry, they're sending a message. They're signaling that future compensation is going to be tightly linked to staying relevant, to upskilling, especially in the age of AI. Get the new skills, get the rewards, helps control the overall expense curve too.
Right. Okay. So while the current revenue picture shows some pressure, especially from those big clients recalibrating with AI, what about the future pipeline? What do the leading indicators look like?
That's the counterbalance. If you look forward, the indicators seem pretty robust.
Yeah.
Let's start with order inflow. That's the lifeblood, right? New deal sign.
Yeah. Absolutely critical. What was the number?
$1.59 billion in Q2.
Okay. 1.59 billion. Solid number.
It is. But what's maybe more important strategically is the consistency. This marks the 4th consecutive quarter where their order flow has been right around that $1.6 billion mark.
4 quarters in a row. That shows sustained demand.
Exactly. And it's up 22% compared to the same quarter last year. So year on year, the demand is significantly stronger. It suggests that once this AI transition phase kind of settles, there's a big backlog of work waiting to convert to revenue.
And are they winning bigger deals, better clients? What about the client metrics?
Good question. Total active clients are stable at 749. But importantly, the number of larger clients, those contributing $10 million or more annually, that number actually increased year on year, went from 88 last year to 93 this quarter.
So not just steady deal flow, but the quality, the size of the clients seems to be improving too.
That's the story the numbers tell. And the specific deal wins they announced illustrate this and also show some diversification.
Okay, like what?
Well, they won a pretty significant contract from the Government of India's Central Board of Direct Taxes, the CBDT. It's to transform the core PAN infrastructure for the country.
Wow, it's a major national infrastructure project. High visibility, high trust.
Exactly. And they mentioned it starts ramping up in Q3, so we should see that impact soon, then internationally.
Yes.
They were selected as a strategic partner by a major global financial institution. This wasn't just a partner. They're positioned as one of only 5 major service providers for this institution across multiple countries.
Okay, being one of only 5 in a big bank's vendor consolidation, that says a lot about their standing in BFSI, despite that flat sequential revenue we saw. It means they're winning the right to future larger pieces of work.
Precisely. It reinforces that the recalibration isn't necessarily about losing ground long term. They also mentioned a large deal with a leading global media and entertainment company. Interestingly, they noted this one has an extended transition period, ramping up over a couple of quarters.
Which again explains why the current quarterly revenue might not fully reflect the strength of that $1.6 billion order book yet. These big deals take time to get going.
Right. And one more, they were selected by a European life sciences company for a large S/4HANA ERP transformation, so hitting key sectors, key geographies, and complex transformations.
Okay, and just quickly rounding out the operational picture that supports the margin story.
Advocate.
Attrition, headcount.
Attrition, looking back 12 months, TTM, dropped slightly to 14.2%. That's pretty healthy for the industry.
Lower attrition helps margins, definitely.
It does, and total employee count actually went up, reached 86,447. That was a net addition of over 2,500 people, including about 2,600 freshers.
So they're still hiring, bringing in new talent, even with all the AI focus and automation potential.
Yeah, it suggests they need the capacity for that strong deal pipeline they're building. Lower attrition, plus bringing in freshers, helps keep that overall cost structure manageable, supporting the margin gains.
Okay, so let's try and synthesize this. What does it all mean for you, the listener? If you were tracking LTIMindtree this quarter, you basically saw them pull off a really tricky balancing act.
Yeah.
On one hand, a big internal win, significant margin expansion ahead of their own plan.
Right, the operational success.
But on the other hand, they had to absorb external pressure. The financial impact of giving AI productivity benefits back to their clients, especially those big top 5 accounts.
The trade-off.
Exactly. So their confidence looking ahead, aiming for near double-digit growth in the second half of the year, it really hinges on navigating this transition successfully.
Yeah, that huge deal pipeline, that $1.6 billion per quarter run rate, it absolutely has to start converting efficiently into revenue.
and overcome those productivity pressures that are currently dampening the revenue from their biggest, most established clients.
Which leads to, I think, a really provocative question, not just for LTIMindtree, but for the whole IT services industry right now.
Okay, let's hear it.
Considering their clear commitment to using AI, their blue-verse tech across everything, how quickly can they pivot the narrative? How soon can they move from talking about AI driving cost savings for clients, that sometimes painful transitionary phase, to actually explicitly quantifying net new revenue streams that are natively built on AI?
You mean showing revenue that wouldn't exist without AI?
Exactly. And when they or any major player starts clearly signaling that kind of AI native revenue, what does that do to valuations? What does it mean for the future trajectory of everyone else in this space? That shift in focus feels like the next big milestone to watch for.
That is the ultimate strategic test, isn't it? Moving from AI efficiency to AI-driven growth. The numbers this quarter were strong, showed discipline, but the strategic story is definitely still in transition. Thank you for digging deep into these results with us today. Until the next deep dive, keep analyzing.